Check, please.
Hey, welcome back to Everything Money. Obviously, one of the biggest companies in the world is Microsoft. We're going to update our thoughts on the stock and the stock price right now. We'll look at the financials using our software and show you what you should be paying for this company moving forward with our stock analyzer tool. Mo, the fearless leader of the Bidnest Nation, will show you how to trade this all and more by the end of this video. Stay tuned. Paul, give me your thoughts on Microsoft, baby.
Thank you, Seth. So Microsoft was a great example of a value trade about 10 years ago. I remember liking Microsoft because I was looking at this thing selling for 9 times earnings. And everybody told me this company's dead. I literally had a tech executive tell me how I didn't understand tech and how cyclical it was, which he's right. Tech is very cyclical. But he said, you don't understand how dead Microsoft is.
We talked about this on the show, Paul. You walk into an Apple store and it's a thing to do. And then Microsoft are just lonely workers just in an empty store. There's no comparison, really. We've talked about this on the show in the past years. I was always shocked how powerful Microsoft was because in the mall, when you walk by, it doesn't seem like anyone's really interested.
Well, remember, Microsoft generates a lot of its money from the software, from all these that you don't go to a store to buy. So you don't go to the store going, hey, show me your Microsoft Word. It's show me Windows. It's a software-based business. Apple is not. Apple's a hardware-based business, right?
See.
So when I look at Microsoft, I remember people telling me it was dead. I was like, if it's dead, why does it consistently generate 8% more in revenue every year? And why does it consistently generate 11% more in profit? Now, I guarantee if I went to that same tech executive, they'd say, oh, no, I never said that. Microsoft's a great company. I mean, literally, I remember being at lunch and I said to him, well, you'd take Microsoft if you could buy it with no debt and $50 billion in cash and $100 billion in cash and only pay $50 billion for it. No, I wouldn't. I was just like, no, you don't understand. Like, you could literally shut it down, get your $50 billion back, an extra $50 billion. He goes, yeah, I wouldn't do it. I'm like, no. And I kept repeating it. He's like, no, I understand what you're saying. I still wouldn't do it. I'm like, well, then you're stupid. And this is a tech executive.
Oh, no.
This is somebody who's paid to help launch tech businesses.
So it's awkward.
That's exactly what we need, though. We need value plays where literally people who are considered expert in a field, like if an average Joe said, well, this guy's a tech executive, he's telling me Microsoft's dead. Obviously, Microsoft's dead. That's what we talk about with independent thinking. I remember leaving that meeting, and I hate to say it, but I never talked to the guy ever again because I was like, this guy is really stupid.
Goodly.
Yeah, well, that's what I do. I'm like, I just don't respect the guy. I've never talked to him ever again.
You're ingraining this in my mind.
I shouldn't. You shouldn't ingrain it in your mind.
No. I just mean in general, the concept of waiting until something is out of favor and then starting to get interested when everyone's not, you know?
I literally automatically go, oh, you don't like that? Great, let me go take a look at it. Oh, you guys all like that? Great, I'm going to avoid it.
He's Facebook right now.
Well, anyway, Facebook I don't think is even to the point of out of favor yet.
No, but in the near term, in a week, it's been out of favor.
Oh, for sure. And now I see the articles about why Facebook is. Yeah, I mean, yeah, but I really wanted to. The Microsoft in 2011 and 12 was literally, how could you ever even look at Microsoft as a company? And since then, revenue's 2.5 times higher or something like that. It's like, okay, sounds good. I guess you're right. I mean, so anyways, back to Microsoft now. Let's look at our 8-pillar software and more on that a little bit later and how you can get it for literally the cheapest price of all time.
Yeah, this stock was $342 around Christmas, Paul. It's $300 now. Quite a fall. Give us an update on your thoughts.
I did part of our software we get exclusive content. I did exclusive video about how I was wrong on Microsoft, but because I sold it too soon. And I sold it too soon, even though I think 305 is overpriced, and we'll get into that later. It was still worth more than when I sold it in the mid to high 50s, right? Because I was like, man, this is getting crazy. But either way, so let's go right to our 8 pillars tab. So we have one of our favorite 8 pillars. Here's why I love this 8 pillars so much. Seth, what's going on over here?
Yeah, so pillar number 1 and pillar number 8 are both equate to over or under valuation. At this point with X's, we're just too expensive. So great company. Potentially.
We don't know for sure if it's expensive, and here's why. What matters most is growth. If there's a lot of growth potential in Microsoft, let's say they're going to grow 100% a year for the next 5 years, this is cheap. This is absolutely cheap. So everything's based on the growth potential of the business. This is the Philip Fisher way of looking at investing. Instead of looking for the cigarette butts and cigar butts that Ben Graham wanted to look for, it's looking at underpriced growth opportunities. And if Microsoft has huge growth potential, and we'll look at it soon with our stock analyzer tool, but if they have hypothetically 100% growth potential a year for the next 5 years, would you ever consider not buying it right now? Of course you would, because everything else hits. They're buying back shares. They have low debt. They have growing free cash flow. They have growing net income, growing revenue, and a high return on invested capital. Why would you not want to own this company?
Okay, Paul, with all this said, how do I translate these 8 pillars, this evaluation, into what the stock is worth? Because I still struggle with this. We can use our stock analyzer tool, but walk me through it for our new users out there.
All right. So every investment is the present value of all future cash flow. If you've watched even 10 videos on this channel, that should be ingrained in your head. Every investment is the present value of all future cash flow. Whether that cash flow is coming every year or one time at the end, it's still a present value of all future cash flow. Now, we don't know the future. That's what makes investing hard. That's the element of art to investing. We don't know the future. We're making assumptions about the future. As my example was before, if Microsoft's going to grow 100% a year, we would give a lot more value to Microsoft than if it was growing 5% a year, right? So we created the stock analyzer tool that allows you to make these assumptions and allows you to it'll tell you based on those assumptions what you should pay for the stock. But some high-level things first. The company is currently valued at $2.28 trillion, not billion, trillion. We've come to the point now where a $300 billion company is considered adorable. Mm-hmm. Like, right? I mean, we laugh at it.
About them.
Yeah, we don't even hear about them.
There's so many times we see a $200 billion company. You're like, I never heard of this before.
Yeah. Okay. Next thing, they pay a dividend. Now, the question we have to ask ourselves is, can they afford the dividend? Because this is one of the most important aspects of people when they go look at a company. Like, oh, I like the dividend. First off, guys, I won't get too much into it, but dividends are tax inefficient. There are videos that we have about that. Look for them. But what we want to do is we want to compare the dividends paid of $17.3 billion. And part of our software, we add the 5-year and last year free cash flow because you have to make sure they can afford that dividend with the free cash flow. And they easily can. It's well under half of their last 5 years of dividends. Of free cash flow, sorry. High profit margin, 69%. This is what a software business gets in gross margin. Unlike our friends at Tesla, everybody says a software business and their gross margin is 20 to 23%. Bottom line margin, 39%. This is after taxes. Tesla is at 7? 6 software business, guys. But 5-year PE of 53, it's very high. So anyways, stock analyzer tool. The first thing we want to do on stock analyzer tool is select the number of years of analysis. And we allow for 1 to 20 years. I always pick 10. Now, here's that first line, revenue growth. And we provide the 1, 5, and 10-year numbers on every company. So guys, your goal should be to be conservative. There are over 10,000 stocks out there you can buy. Be conservative. Don't be so conservative that you're unreasonable. But just sit there and say, okay, let's say the next 10 years the company grows reasonably. Not hitting out of the park. Like I'll have people come to me and say, Paul, you'll be proud of me. I was conservative. And they'll put in a 10-year number in here at like 13%. I'm like, but they didn't do 13% in the last 10 years. Now, does that mean they can't beat the last 10 years? Absolutely not. But my goal is to be conservative and then find the obvious purchases. Mm-hmm. If it's not an obvious yes to me, it's a no, right? So for Microsoft, I'm going to do 5, 7.5, and 10%. And I think 10% over the next 10 years will be difficult, but that's fine. Let's do this. Profit margin.
Paul actually went higher than me.
Higher than you, Mo?
Oh, really?
Yeah, I was going 5, 7, 9.
Look at you, just loosening up that belt. Really, you're a glutton now.
I'm just throwing money all over the place. And by the way, that might be my bias of like, man, I haven't bought a stock in a long time. Maybe I need to be more liberal in my underwriting. Bad news for me. I'm going broke now. Guys, profit margin. Last year's profit margin was insane, 38.5%. In the last 10 years, they did 27.3. In the last 5 years, 30.9. And I do think their margin will be closer to that 30.9 because they're doing a lot of cloud computing. So you have to be very careful here. Do you want to put 28% in? I don't know. Maybe, Mo, what were you thinking? Since Big Shot over here is Mr. Conservative now.
Yes.
Mine was going to be in the 26, 27 range.
Really?
Yeah. So okay. Here's my reasoning. They are already in that cloud space, and that's what a lot of
but it's growing.
It's growing, but again, $2.2 trillion company.
Well, don't worry about that. Worry about the revenue. Don't worry about the market cap. Worry about the revenue. And I'm looking at it as, how about I put 26, 28, and 30. Oh, like if they can sustain their last 5 years on the high side, that'd be great. All right, free cash flow margin.
The only reason I would say 30 is too high is because it's incorporating this past year.
Yeah, but that's one. It's not like it was
1 year in an anomaly.
It's not like it was like 4% here or something like that. You know what I mean?
Yeah,
it was pretty close to it.
Yep.
Okay, what about free cash flow margin? I usually go the same number.
Maybe go a little higher here.
So let's do 27, 29, and 31. Okay. PE. Guys, this is a huge company. I'm doing 13, 15, 17. If those of you who are going to hate on me, I'll sit there and say, guys, the larger the company, the less potential for growth. The less potential for the growth, the less you should pay as a multiple. Now, Microsoft is very big and established. I can see the argument for 14, 15, 16, but 13, 15, 17, because if they do hit the high growth numbers, they're worth they should be worth that.
Right.
And then 12.5% return, guys. The reason 12.5%, you can invest in an ETF and get 9 or 10%. So in order to do an individual stock with margin of safety, do 12.5%. Now, hit the analyze button. Seth, what do you think this is going to end up at?
Well, so before you get to that, I'm always confused because you always say when a company gets this enormous, it can't grow. Yet, sure enough, we're seeing amazing growth out of one of the biggest companies. So what is the disconnect I'm missing? We've chastised someone like Meet Kevin because he said when Tesla literally has a GDP, their revenue is more than the United States GDP, they'll continue this amazing growth with the 70p. So what am I missing? This is a big company. They're growing.
Yeah. Okay. So let's look at so I'm not saying they're not going to grow, but the question is, are they more likely to grow faster or slower over the next 10 years after they've already grown a ton?
Yeah, growth becomes a little more difficult.
Yeah. Right. So like our company, we do $20 million in revenue. Well, I should look at this. Everything Money. We did 5,400% more in revenue this January than last January.
I see.
Do you think we're going to do 5,400% again next January?
No.
Yeah, no, of course not.
Why?
Well, we're already at a level where I see what you're saying.
It's just harder to grow. I mean, it's been proven time and time again. The larger something is, the harder it is to grow. Look at the U.S. economy. The U.S. economy will not grow as fast as China and India or Africa. Why? We're already so stinking huge.
I see.
Does that mean we're not going to have spurts of larger growth? Absolutely, we will. But overall, you're going to have slower growth the larger and larger you become. Mm-hmm. Let me go another extreme. If you weigh 300 pounds versus 140, is it easier to gain 10 pounds at 140 or 3? I mean, it's always going to be easier the smaller and smaller you are, everything you do. Is it easier to grow your income 20% when you make 10 million a year or when you make 10,000 a year?
I think I keep making the mistake that in these rosiest years of a stock market, that 20 looks like, oh, we can do that again, as opposed
well, remember,
to
this
maybe
is economy, not that. Revenue is driven by the business fundamentals, not the stock market necessarily. Just remember that. So,
well, it's somewhat of a popularity contest, right? I mean,
well, true, but the business if the stock fell down 50%, does that mean the revenue is going to fall? No, of course not.
Okay.
Correlate.
No, I'm sure there is a correlation over longer periods of time, but not 1 year at a time.
Okay, hit the analyze button. Let's see what kind of prices you're looking at here.
170?
Low end, basically 85 to 90. High end, 165 to 170. Middle, about 120. Paul, there's no way the stock will fall to 120. Okay, Peloton fell 80% after numbnuts. I recommended it a year ago.
Mm-hmm.
All these, go look at history. Microsoft hit a peak of $58 in 2000, and 8 years and 12 years later, it was still in the $20 range. It crashed all the way down to $11. I don't want to hear it. I don't want to hear it. And if you don't believe me about Microsoft, go look at articles about Microsoft back in 2000. It was, I remember my dad saying the only stock I'd ever invest in is Microsoft because it's the only good company out there. And when he said that, the stock ended up going down 80% from there. All right, what do you want to do? By the way, the other thing is you have 10,000 stocks to choose from. Find the ones that fit your parameters. And by the way, I would add watch list. Add this to your watch list. Watch list coming soon in our software. Add this to your watch list because this is the companies that have 6 check marks, but the overvalued parts are the X's. Those are the ones you want to pay attention to because eventually those prices will fall and the overvaluation will become less. So do that. And I want to own Microsoft again, but I got to wait. I got to be patient for the right time. And right now is not the right time in my opinion. Now, can I be wrong? Absolutely. I was wrong before. I sold Microsoft $55 thinking it was worth 40. Now I think it's worth 120. Okay, well, I was wrong there. Great. I got the growth assumptions wrong. That's the way it works. I'm okay. The thing that makes me happy is at 13, 14, $15, I was saying it was a great buy, and everybody else was saying it's a dead company. I still quadrupled my money. I win. Okay, fine. I want my losses to be because I quadrupled and I could have, been higher. So anyways, this is what I'm saying, guys. Just remember these things as you go forward. It's about being cautious and conservative and finding the right opportunity. If it's not an obvious yes, it's a no. At 305, let's look at it this way. What would Microsoft have to grow to get the middle range to 305? What's the growth rate have to be? Let's go 10, 15, 20% for the middle range. Nope, still not there. On the high side, it's getting there at 20% revenue growth. Guys, 20% revenue growth in the last for the next 10 years. They did 11% in the last 10 years. The middle number is still not even close. Okay, let's go 15, 20, 25. Just barely getting there now. So the middle range, the mid-range has to be a 20% revenue growth. It's not going to happen. I shouldn't say that. It's highly, 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 highly unlikely that in the next 10 years, the conservative estimate is they do 20% revenue growth a year. That would take their revenue. What did they do in revenue last year?
Let me tell you.
184 bill.
That would take their revenue from 184 billion to 1.1 trillion dollars.
Revenue?
Yes, revenue. 1.1 trillion dollars. That'd make it twice the size of Amazon right now. Is that possible? Sure. Is it probable? If you make every investment based on what's possible, why are you even investing? Just go buy lottery tickets. Just do that. So anyways, that's my take on Microsoft.
If you watched our channel in the morning at 9 a.m. Eastern, you've seen Mo give you news, notes, analysis, sarcasm, and stock trading. If you're interested in drawing to stock trading, Mo on every episode shows you how to trade this puppy. Mo, what are people doing with Microsoft, whether it's long-term or day trading? Talk to me, baby.
So here's the thing about Microsoft, and people just keep saying, like Paul just said, it can't go to 120. Okay, well, this is Microsoft's chart right here. Pay attention to exactly what it's done. We've gone up, we've gone down, we've had this big long wick, and now it's kind of stabilized. I'm going to pull up the S&P. It's almost the exact same chart. So my point, you even have that long wick that happened right there in January. What my point is here to say is wherever the market goes, this is going to go. So if the market collapses, this is going to collapse with the market, guys. It can happen. But right now, we're in this consolidation channel that is linked back to September of last year. So right now, what I would tell you to do, or what I would do personally, I would wait for this thing to turn up, get a little bit of a sweet spot reversal, and see if I can add to the high side. Otherwise, I would wait until this starts dropping and takes out that long wick from January 24th, I think it was, and that's when I would go short on this. If you want to do something from a swing trade, you can just pay attention to the moving averages that it's at. It is hovering right between two major moving averages, the 100 and the 200-day moving average. So it's just going to bounce in here for a while until something happens. It's either going to go this way or this way. Just be ready for it and follow that trend. That's all you got to do.
If you want to learn more of an in-depth analysis of how we use our 8-pillar, 8-metric system, you can click the card in the top right-hand corner. It'll take you to a video where we talk all about it. Hey guys, Seth here, jumping in real quick. We'll get right back to the video, but I want to let you know you can join our software. You can get access to this financial data and the new Everything Money chat right in your phone. Paul will tell you how to get it right now.
So guys, we created the software because our users wanted to be able to analyze their own stocks without having to wait for us. So we put hundreds of thousands of dollars, made the software. You get 30 years of financial data. You get access to Seth, Mo, and I, 8-pillar analysis, the stock analyzer tool, the retirement calculator, and you get everything on this main page that is coming soon. This is all included. And if you look right here, these are all the things you get. You get everything on a mobile phone. Everything we're talking about here is ready, available on your mobile app. One app for everything. But most importantly, guys, you get our Discord, our community of, now it's off of Discord. It's right in our app. You get a community of over 6,000 people you can talk to every single day about your investment ideas. If you're like them, you felt alone having these ideas about investing that weren't reciprocated by others, but now you found the community here. And this is all available for only $1 per day. Less than a cup of coffee. If this can make you 1 or 2% or save you 1 or 2% of losses every year, it will lead to hundreds of thousands, if not millions. $1 per day, 2 ways to sign up. everythingmoney.com or Patreon. The benefit of everythingmoney.com is we're not large enough yet to charge sales tax, so you won't be charged sales tax quite yet. And look at this, guys. You get all of this. Our competitors are a lot more money and don't provide as much. $1 per day. Go sign up now.
Paul, your final thoughts on Microsoft?
Just be patient. This is like a lot of companies out there, just overpriced. There'll be great opportunities in the future to buy great companies at much better prices. Please be patient. We're trying to teach a process and patience here. As I said to Seth the other day, he said, I'm sick of being patient. How long do I have to be patient for? And I said, the rest of your life. Good investing is about patience and taking the emotion out of things.
Tickle that thumbs up. See you next video.